Hello, everyone. Welcome to our January 24th edition of the Governance and Risk meetings at MakerDAO. We have part two of a special series of meetings today related directly to the stability fee and questions around how it's managed, what it's for, how we should use it as a policy tool, and more specifically, the reason why this is becoming such a it's been raised to the fore is because we're reaching a point where it's probably time that we start reevaluating what our current stability fee is, and we'll get into that discussion more deeply in a bit. I've posted a link to our Reddit thread in the chat at the side of the window. Please take a look at some of the questions and suggestions that arose from last week's meeting, and if you feel that any of these aren't getting enough attention, please jump into the call, speak up, or type a question and raise those points again if we don't get to them. And in general, please feel free to ask questions whenever you like. Keep on saying this, but there's a lot to go over, and there's a lot of really clever people on this call, and everybody should be heard. So don't be shy about just jumping on the mic and asking a question, or typing a question in the chat. And if you choose to type, David or I will keep an eye on it and ask the questions when there's a quiet moment. All right, Steven, I'm going to hand it off to you. So.
Okay, super.
Go ahead.
First, welcome everybody. Thank you for joining. And the one thing I wanted to start off with, going through the questions and having a look at some of the comments we received, it became clear that I need to just go over what that stability fee is. And what are the components of it and how you can use the stability fee. Because there's two aspects to it. There's this aspect where it covers risk management, and there's the aspect where it basically acts as a policy tool. So now, to that end, keep in mind that the stability fee has three very important components. The one is the component that covers inflation, the component that covers the operational costs of the organization, and the component that covers the credit premium or the inherent risk of that particular collateral type to the organization. Now, those are the three components that make up the stability fee. In the difference with an interest rate is that an interest rate would have a fourth component being a liquidity premium, but it doesn't really apply to us for obvious reasons because there are no durations on the actual loans. But that being said, let's just go over that again. Inflation, operational, and credit premium. Now, what we're talking about today in terms of a policy instrument is more focused on the operational component. And that operational component has further layers. That one layer is obviously how much does it cost to run the organization. You need to be compensated there. And then the further two point to the policy instrument that is specific to the collateral type, and the policy instrument that is more general to the system as a whole. So what we're talking about in terms of increasing or decreasing the stability fee, which I think we should now start focusing on the idea of the DI savings rate, which we can come back to a little bit later, is that we got to look at it in terms of a policy instrument for the portfolio as a whole, for the system as a whole. That's how this discussion should be framed. But it should not be forgotten that the stability fee has many other characteristics that provide different functionality to the system, specifically to the inclusion of collateral types to the risk portfolio and the control of the entire portfolio as a whole. Now,
that's really interesting, and maybe I'm going to jump in and make sure that I understand the nuances here. So it's a great point because we talked about the stability fee, or at least in the last meeting, the stability fee conversation was around supply and demand, basically. And towards the end of the call, there was sort of this dawning realization where we started to understand that it's also a source of funds for operational expenses. This is how in the future we're going to be covering the decentralized aspects of the system. So maybe the risk teams are paid from the revenues or the surplus from the stability fee. Would you say that that's kind of the two primary considerations when we're thinking about the stability fee? Obviously, we need to remain competitive. We need to incentivize supply and demand in a way that's healthy for the ecosystem. But we also need to keep in mind or I guess I'm asking, do we always need to keep in mind what's the impact of the operational success of the organization?
Well, the short answer is yes, because the stability fee is multidimensional. There is this inherent abstraction to looking at one number representing an interest rate, as we see in the traditional world with the Fed funds rate or with the policy rates, and you think that that represents like one simple function, but actually has a multidimensional impact. And that's really how you need to look at it. You need to look at the stability fee and say, well, what components are we talking about, and what are the ideas around that particular component? If we're talking about the inherent credit risk of the collateral type in the portfolio, we're talking about the credit premium. We're talking about how much MKR governance must set aside of itself to buffer or risk budget for that particular collateral type. But here we're talking about operational. We're talking about the policy component that is very specific to the system as a whole. And the other part about this is, your notion of an interest rate or of a rate is generally very small. You think about 5%, 10%. If you're in developing economies, you might think 25 and 30%. But still, the relative proportion of change is always within a certain reasonability framework. Like going from 25% to 20%, it's a big change. It's 5%, but relatively speaking, it's not really that big. But as soon as you come down to a bootstrapped ecosystem like ours, and you start looking at changes from 0.5 to 2.5 and back to 0.5 again, it is symptomatic of the fact that this is a system that is getting going. This is a system that is getting its feet, finding its feet and getting traction and getting adoption. And that is the business aspect we got to realize. And to that end, we need to also keep in consideration what the metrics we need to think about that guides this process. The previous meeting, we spoke about finding a policy exchange rate to which we can look at and use as a first point of call. If there's a range around that particular policy rate, maybe we can act on it. But the idea here is not to think of it as an algorithm, not to think of it as, oh, if this happens, therefore we must do that. These are triggering moments where collectively, with the inventory in the system, with the dislocation with demand and supply, and all the first and second order metrics that we can use to identify that, will provide and inform a dialogue within the community to figure out how we're going to go about adjusting the fee. The sense of an algorithm in the idea of economics, and this probably is a reference to Thomas Piketty, the guy that just recently wrote a tome called Capital in the 21st Century. He reiterates something here that thinking of economic science is a little bit of a misnomer. You've got to realize that economics is a social science, and within which we're using the best forms of models and rigorous thinking to support our evidence as to what we need to do in the system. And that's how we have to frame it. We're going to make sure that we are not just falling into this blithe idea that we can just create a nice algorithm and switch it on and it'll work for us, because that's never going to happen. It can happen to a certain extent in informing our decisions, but ultimately that decision is quite subjective and is really dependent on the community. And the more traction we get, the more adoption we get, the more input we have, the more robust the process becomes. So that, keep that in mind.
Okay, I just want to make sure that I've understood this conception. So I'm going to take a little step back. So when we're talking about the stability fee and the intentions to raise or lower it in the short term, it feels like this sort of ties into a larger meta issue where it behooves the MakerDAO voting community to act in our own best interest, but that best interest should be viewed over a long time scale. So we need to incentivize the success of the DAI stablecoin, potentially at the expense of burning great deals of Maker in the short term, right? And it feels like this touched on some issues we addressed in the last meeting, where we realized that remaining competitive on our rates is important because the market is getting crowded. People are realizing that this is a good idea. We see places like Compound, and there's others that are coming up. we also need to manage supply and demand, and this is the primary policy tool to do that. So do we focus on those two first categories and then worry about operational surplus, down the road, maybe next year or the year afterwards, or is that something that should be baked in right now, or we're considering it?
Unfortunately, this is something that you have to consider all at once.
Mm-hmm.
There is no leeway in one determines the other. Unfortunately, they're completely interrelated. I give an example. Creating the collateral portfolio will define the sort of stability and will define the stability through the use of CDP. So therefore, you've got a supply function well defined. But if you've done extraordinarily well on selecting the collateral types, you'll create an oversupply in your function. And to that end, it also talks to what's the business rationale of including those collateral types, not only in terms of them as collateral, but how they can be developed on the MakerDAO system as well. Further to that, it informs us, informs the idea of what is the supply going to cater to, what's the demand, how does that demand look? To that end, what is the business rationale and the diversification of use cases that can balance off the supply? We may need to address that as well. And that is all inherent in the understanding of not just the risk dynamic, but the economics dynamic as well. And also to a certain extent, and this is very important, the social contract that you have with the stakeholders in the system. So the short answer is looking at a policy instrument by itself, sort of, I think the Latin term is ceteris paribus, with everything else remaining equal, is easy enough in order to discuss what we need to do. But when it comes down to practically implementing it, we've got to make sure that we are fully aware that in the real world, things are interdependent and interrelated. So we need to move on that premise. And that is why you need a sort of a community input to find your collective rationalism in the governance that you want to use. Scientific governance is a very important and most profound starting point in developing a rationale, because it reduces contention, it reduces the possibility of factions. But does it reduce or mitigate all risks? No, it doesn't. But it certainly puts us ahead of the game and certainly makes us a hell of a lot more competitive than other folks who are choosing more subjectivity, or rather injecting a lot more subjectivity in their governance process. So on that point, I'll pause for a moment because that's a lot of information. Are there any questions, comments?
Yeah, I have a question. So I understand the three components, right? Inflationary, operational, and then the credit risk premium. Mm-hmm. So I can wrap my mind around the operational and the credit risk, but can you talk more to the inflationary component and how we judge for that? Okay, so this is actually an interesting point, because if you assume for the moment we're at an asymptotic level of supply, let's say it's 2.3 trillion DAI. Yes, I know that's a lot of DAI, but I believe we're going to get there. And it just hovers around 2.3 trillion. It might move up slowly, it might move down slowly. The issue there is that the compensation or the compensation for risk must include the inflation component for MKR governance, because if you don't have that, you're going to have a devaluation in your purchasing power. So the inflationary component just makes up for the purchasing power. But if we are not at that asymptotic level, if we are constantly growing, then as long as the growth of supply in DAI is greater than, obviously we're hoping it's going to be much greater than the inflation rate, you don't really need to worry about that, because the growth in the supply of DAI actually compensates for that. So there's a sort of an indicator function that you need to put there, sort of a binary component, which says that, as soon as we get to more of an asymptotic stable level, then you need to start compensating for inflation. So strictly speaking, the stability fee in the bootstrapping phase is really all about operation and credit. Does that make sense? Yeah, so, I think that makes sense to me. Oh, sorry. Yeah, no, you can go right ahead. Yeah.
So I just wanted to follow up on that quickly, just because as I understand it, okay, maybe the inflation component isn't super important to start, but the other two components seem to be at least in my mind, and maybe I can be convinced otherwise, above zero, right? I can't think of the concept of a negative credit risk, right? I can't think of the concept of you paying out of operations for somebody to take out a loan. And we've gone back in some of these discussions and talked about the idea of a zero rate or a negative rate. I mean, in this model, insofar as we take each of these three components, I struggle to see what would have to change with those three to justify a zero or a negative stability fee.
To be honest, I pretty much struggle as well. It's probably an edge case I haven't thought of or has yet to be defined, but imposing a negative stability fee, I don't see a rationale right now as to why you would have it.
Well, I probably only imperfectly understand the system, and I know that Rune is here, and it's all in his head, probably clearer than anybody, so maybe he can explain. But the discussions that I've been involved with where there's any mention of a negative stability fee, we're deep into the weeds of a highly theoretical future where things have gone badly wrong, and the system is attempting to correct itself. And I believe that, Rune, correct me if I'm off base here, but we potentially consider a negative stability fee if there was simply no more DAI to be created. We'd hit the debt ceiling, the other things in the system were happening that were causing instability, and we severely needed to disincentivize people from creating DAI. Is that true, Rune?
Yeah, so I mean, actually, so the reason why I joined the call now, right, is because, well, in the past I haven't been joining these calls because I deliberately wanted kind of the conversation to evolve on its own and really get some proper organic community governance going, right? Because I'm kind of the guy that has all the answers, including this. I mean, let's talk about this in a moment. But actually, what I think it's really awesome, the level we've, like, sort of the point we've come to now, right? And I think the last discussion really showcased that, right? How we're able to have this like proper organic conversation, and a lot of people are really on the same page with this kind of stuff. But what I think needs to happen now, right, is and that was, for instance, what sort of drove the interest yesterday, right, is that it's time for this meeting to become more actionable, right? This is about actually controlling the system, in addition to kind of talking about a theory and knowledge sharing, right, and people getting smarter. And I think we can also, like, in addition to what we've been doing so far, which is really like spreading knowledge and talking about a lot of theoretical concepts, is also there's like this attempt to kind of like actually dumb things down, kind of like let's sort of identify what is the really simple stuff. That's kind of like what's the basic stuff you really got to focus on. You're really gonna, like think about in the short run, right, for like our immediate needs, and so we can get this also, like, we can both have this theoretical understanding of governance for the future. And I mean, an example of that, right, talking about inflation in the long run and negative stability fees and and edge cases. But what's really exciting right now, and what I hope we'll focus on for this call is, like Steven was saying, right, and what we were also talking about last time, right, that basically what's happening now is in the foundation's temporary risk team. The numbers and the data is sort of looking like there may be need for a stability fee change, in line with how we've sort of initiated those in the past based on data that we're looking at, right? And a lot of that data is kind of like proprietary data, because it's mainly about inventory levels that we also think. I mean, and this is also what we talked about last meeting, right? Like, inventory levels is very critical data point. But now we gotta start moving towards a stage where we actually start to sort of publish and classify, kind of like think about different types of data we can get, and then what we do with that data. And then there's just a couple of like things, like starting points, I think we really need to establish and really all like get totally aligned on, in terms of like what's necessary so that we can be actionable, so that these meetings and so the community can actually make decisions. And I think number one is that we're very focused on what we make decisions about, right? Right now, it is about balancing supply and demand for DAI. So actually, it's very important that we don't get like that's kind of like remains the core focus in the short term, right? That's what we focus on, really like squaring like what we aligned on, and what the important things are, and kind of like how do we dumb it down, how do we get everyone to understand what's going on. Whereas the other stuff is kind of still, it doesn't have to be solidified yet, right? Like we can be very all over the place with how we think about risk management, how we think about negative interest rates, or whatever, all these theoretical things.
Well, that feels like it's a good starting point to maybe test out how that mechanism would work. So let's start off with, well, actually, I don't want to leave this mystery laying around. So could you wrap up the potential for a negative stability fee in like a sentence or two, and then we could move on, because that's a question that keeps on bouncing up and down.
Yeah. So actually, but let me start by saying the important thing here is to, like Steven was saying earlier, right? When you think of the stability fee, like if you think of it right now, you actually need to think of it as two things. And also maybe you can think about, like, instead of saying stability fee, let's say borrowing cost, right? When you're a CDP holder and you borrow money from the system, you're paying some sort of cost, right? Some sort of time value of money. And actually that's the point, right? It's more complicated. There's the time value of money, but there's also the credit risk component to it, right? And that's kind of how we got to split up this borrowing cost, right? On one hand, there's the risk-free interest rate, or like the value of capital in general. And then there's sort of the specific risk for the particular collateral that you're putting in, that you're sort of exposing the system to when doing this transaction. And when we think about, like, and the thing that whoever it was before, I think it's Chris Bernisk's partner or something, which is pretty cool, by the way.
It was Alex Evans. It was Alex Evans, our crypto economics analyst.
Alex Evans. Really cool to see you guys here, by the way. It's very, I don't know if you've been on the calls before, but I was very pleasantly surprised to see you on the last call.
We're happy to be here.
And we're happy to have you guys. But so what the point you were making, right, is that the concept of like negative credit risk and that kind of stuff, totally nonsensical, right? It doesn't make any sense. But that is the part, like, but that is only part of what actually drives the borrowing cost, right? So if we think of it as kind of like it's like, this is the total borrowing cost. This part is the risk premium. The risk premium cannot go any like beyond here or something, right? It always is always some semblance of it. But the thing that can go negative is like the time value of money, basically. And the way that goes negative is if it goes negative in general, like if the central bank or whatever, the entire economy of some particular currency decides now there's negative interest rates, right? And the way that would look, what that would look like in reality is that all the collateral that we start using, like all the low risk collateral for DAI would all have negative interest rates as well, right? So if all the government, like tokenized government bonds, all the stable coins, all the like other, like let's say mortgage-backed securities, they all pay out, like they literally are assets paying out negative yield or like zero yield or something like that. That's the point where, you know, you'll have, like, if DAI then, like, if everything else in the economy is paying out, is like giving you negative yields, and DAI is like a stable coin that, I mean, then DAI looks very, look, if DAI has a positive savings rate or like no savings rate, just like it's just stable, it's going to look incredibly attractive, right? So you're going to see a lot of people buying that, and that's going to then drive up the price of DAI, right? And that's where we then, like, our DAI savings rate adjustment process is then going to look at that and be like, okay, look, the price is too high, we got to adjust the savings rate down. And that's where we basically, at some point, we could actually be at a situation where the savings rate is already zero. We got to set low on that. That's when it goes negative. And then there's some really, and
sorry.
Yeah, then there's some really annoying like UX disadvantages to this. I mean, we also saw that when interest rates went negative in the real world, like a couple of years back, right? Like, here in Denmark, we had some weird like banks software crashing because mortgages went negative, and there was like the software just crashed because of it. And there would actually be some like small version of that happening with DAI as well. So it's not really the greatest thing ever, but like the system does technically support it.
Okay, I think we can firmly place that into the theoretical future event kind of category. So, but like you said, we'll have the DSR at that point, and so there's a lot more. There'll be more levers we can look at before we need to consider a negative savings rate. But at least that gives us something to respond to people too when the question inevitably comes up. People just love to latch onto this idea. Well, I want to circle back to what you were saying earlier, though, and I think that this is probably a great opportunity for us to pivot, like you said, the intention of these meetings from theoretical discussions in philosophy and background in education and over to actionable plans. And so you said that that the foundation risk team, and I'm paraphrasing right here, the foundation risk team has identified an imbalance in the supply and demand of the DAI stablecoin, and that you'd like to take the opportunity to use these meetings to figure out what our plan of action is. How do we move ahead? We need to change the fee. How much are we going to change it by? How often are we going to change it? And I think that we should experiment with this idea of using this as a forum to arrive at those decisions, which is great because we have some heavyweights in the call and we're all super smart and we're all super interested in MakerDAO. What I want to do is I want to ensure that we're all on the same page and that we haven't lost the progress that we made in the previous call. So what I'm going to do very quickly, and this is going to be slightly boring, but I'm going to paraphrase the questions that we raised in the last call, and I'm going to paraphrase the suggestions that were proposed in the last call. If you hear something that piques your interest, you think is a key point, make note of that, and we'll engage it into the discussion. So after I'm done reading these things, Rune, what I'm going to do maybe is pass it off to Steven or you, Rune, to kind of set the stage of what our proposal is or what we think maybe the foundation is going to do in order to correct the supply and demand imbalance, and then we can see how it maps back to the conclusions from our last meeting and whether those questions were identified.
But let me just comment there. So,
sure.
So we don't like the reason why the last meeting was like, let's talk about stability and stuff, is because we actually don't want that. Like this time, it's not going to be the foundation. It's going to be like, hey, it's time to do something. Rather, the goal is that we're going to talk about what kind of data is interesting, right, and how we sort of deal with the data and how we make decisions based on that data. And then in the near future, we'll actually figure out what kind of data we can actually publish. And then we'll have, and then as soon as possible, perhaps even next week or the week after, we could have a meeting where there's basically data is presented, like models already exist and an understanding already exists that can process this data, and a decision is then made. And as a result of that decision, then someone, like anyone from the meeting, probably is going to be someone from the foundation, right? But it really could be anyone, creates a proposal for MKR holders to then decide to change the stability fee based on what our scientific consensus here is.
Okay, cool. Yeah, that sounds like a great plan. So I'm going to repost the link to the Reddit summary in the chat for people that joined late. And here's my rapid fire recapping of the things that happened in the last meeting. So we asked some key questions that are designed to allow us to answer some of the questions that Rune was just mentioning to us. And the first one was, what are the canonical points of reference for the exchange price of DAI? So how do we figure out what the real price of DAI is in a market that's rife with wash trading and other types of foolishness? Second major question, this speaks exactly to what I'm hoping Rune will give us some clarity on, is how do we know whether there is a supply and demand imbalance? Who actually holds the data that can prove that this is the case? How do we know when there's a prop desk or a market making organization that's facing an inventory problem? The next major question is, how do we react to these imbalances? How do we alter the stability fee in increments over a predictable amount of time, or do we sort of rip the Band-Aid off all at once? What percentage of drift from the peg do we begin to initiate the governance process to exercise the stability fee process tool, the policy tool? So do we use the peg as an indication of whether the stability fee needs to change, or do we look at potentially proprietary data that implies that there's an inventory problem? One of the major questions that we keep on coming back to over and over and over again is, where do we find clean and trustworthy data? That's a huge problem in our space. How do we know whose exchange data is believable? How can we, this is another interesting one. I think that we should really focus on this in the future, is how do we know authoritatively that a change in the stability fee was directly responsible for the change that we saw in the market? Because we're in a complex and young ecosystem, and it's very difficult to tell whether a lever on our side moved the needle somewhere down the line. We need to figure out what the appropriate models are we can use to anticipate the results of the stability fee changes. That's a complex issue. I can skip this next ones. How does the wider community interact with and inform the activities of the risk teams? And that's one of the things we discuss, or we're figuring out in these meetings in real time, I think. This is something that's been discussed in the past and planned for the future, but should we create a feedback mechanism to manage small movements of the stability fee? And do we understand the risks there? And how do we better communicate? This is something that should come out of the meetings after we're done, maybe next week. How do we better communicate the fact that the stability fee is a variable rate, which I think has implications for larger holders that I hadn't considered in the past. And it's just something that people don't quite understand when they're coming into the system. So I know that that's a bit of a data dump, but please keep that Reddit thread open and reread it at your leisure as we're chatting the rest of the call. The suggestions that we came to were kind of few and far between and not very actionable, but there's some interesting stuff here. If MakerDAO is in fact a credit facility, it must ensure that the stability fee remains competitive. So we have an upper bound on what the stability fee is potentially based on the other people in our space. We need to ensure that the negative effects of the variable stability fee are compensated with by directly producing a more stable peg, which is ultimately what the entire organization is about. We need a stable peg. Any updates we make to the stability fee must take into account the size of the change as well as the frequency. The community must be willing to make nimble changes to the rate, which could in itself have a stabilizing effect on supply and demand. We need to determine the trigger that brings the community consensus on these rate changes. And we need to optimize the collateral portfolio to minimize risk while optimizing for business efficacy. All right, so there you go. I forced everybody to listen to that, but these are all important discussions or topics, and we'll probably be touching on some of them into this week's meeting and next week's meeting as well. So with those things in mind, I guess that kind of places us at the point where there's a supply and demand imbalance, and how do we move forward in that? So I'm going to kind of kick that conversation off with the thing that interests me the most, particularly, is how do we know that there's a supply and demand imbalance right now? Where did that information come from? How did we measure it? Things like that.
And how can we capture that information for the future?
Yeah, so before we talk about that, though, I want to talk about something more fundamental, because there is a lot of these questions, like a lot of this stuff here, actually it's based on kind of like a wrong assumption. And the best way to really talk, to talk about this is to talk about some history and go back to the old days of Maker when DAI was pegged to the SDR, and we had this nice little thing called the target rate feedback mechanism. So the target rate feedback, which is actually still in the white paper to this day, right? It's going to be replaced soon. They'll finally get some consistency, and it's going to be replaced with the savings rate. But so the target rate feedback mechanism was described as this like algorithm that, you know, there would be some lines of code, and then that code would then ensure DAI was always stable through some algorithm. And I think this is, and I see actually one of the questions here is like, can we do that, right? Can we make an algorithm that just like looks at small changes and then makes a response based on some math, right? And as Steven was saying earlier, the answer is no, we can't. It can't be done. And this is one of the big sort of realizations we came to with the TRFM. And the reason why that can't be done is, well, I mean, like you were saying, Rich, right? It's because there's no such there's actually no such thing as data, right? Like real data really doesn't exist, right? It's like signals or like shadows in the wall in a way, right? You don't know what's actually true. And if you do something as naive as kind of like take data as the truth, then someone will figure out how to make money by manipulating that data. and then mess with you, right? So, and once you realize the ramifications of this, right, that we actually don't have any, like we don't have objective truth to rely on, that's when a lot of the other stuff becomes very, very difficult, right? And also, and it's also just, I mean, there's also just like we're now then like sort of seeing the tip of the iceberg of just how like what does stability even mean, right? Like what is the goal even of what we're trying to achieve, for instance, when we do this stability fee change, right? Because and then I mean then there's this initial question, right? This is really the perfect way to think about it, right? What is like the reference for the exchange price of DAI, right? Because in a way, like actually the sort of the holistic way to look at that is actually that's totally subjective, right? Like this, it's like or rather, I mean, there would be a decision to whether it should is the goal of DAI to sort of be optimized for Wall Street people in New York, right? Or should it be optimized for people in some other place, or should it be sort of like optimized equally for everyone and kind of like be as a like sort of as fair or something to everyone without really like playing favorites to any particular people? And this is really like this is such a complicated kind of like this is not really something that you can't really like look at some data and look at some models and then come with an answer to this question, right? Especially not for the long run. But I think for the short run, we can think of it as something like, I mean, this is like it's about kind of the usability of DAI in the short run, right? It's like about like and sort of the attractiveness of DAI in terms of its value as a stablecoin, right? So we get back to that. What does it mean with stability? And then that's where you get to exchange rates. That's kind of what most people think of in stability. But also, I mean, very quickly from there you get to what also liquidity, right? I mean, an exchange rate isn't just an exchange rate. It's also a matter of how much you can move with that exchange rate. So basically there are two like the really big pieces of data that we have looked at in the foundation, and we've made these stability proposals to change the stability fee in the past, right? Has been basically it's been looking at the exchange rate on almost basically like looking at coin market cap, right? I mean, obviously it's a little bit like you don't want to actually look at coin market cap. You want to sort of use coin market cap to find all the exchanges you can find, and then look at the actual exchange and look at their data, right? Because coin market cap doesn't necessarily faithfully reflect the real data that exchanges are outputting. It sometimes like messes with it a little bit. But that's like one very, very obvious thing to look at. However, already here there's some pitfalls, right? If you look at something like the exchange rate of like the price of DAI in a DAI versus ETH pair, you're not really going to get the full story, because you're also going to have like a lot of uncertainty and volatility introduced from ETH. So actually, what we found is this isn't actually very it's not a very good measure for kind of for precise adjustments, even though the adjustments we've done in the past have been major massive adjustments, they've actually still not been done well. I mean, they've not been I think the most obvious case was when we did the decrease. We went from 2.5% down to 0.5%, right? At that point in time, when you went on coin market cap, you'd actually see 1.02 for DAI on every pair there, right? So even someone just looking at coin market cap, someone some regular person would be like, that's not stable, is it? Right? You'd actually most people would agree that that means it's unstable because it's overpriced, so we've got to do something to bring the price down. But yeah, the other really big thing is, as I was talking about earlier, is the inventory levels for liquidity providers. So big traders that are actually the ones that go on these markets and buy and sell DAI against the other assets. And so I think what we should talk about now is a starting point, a rock kind of we can set by introducing kind of something simple, kind of a simple what do you call it, almost dogma or something, right? Or axiom you can kind of like simplify the whole discussion, right? And this is the thing that was also talked about in the last meeting. That is that what if we agree to initially look at when we do adjustments, we do it in increments of 0.5%, because that kind of like sets the stage for what is a level of granularity and like what is the type of signal that's necessary for us to actually take action, right? Because if we say it's like 0.01%, right? We want to do these like super tiny, precise adjustments. Then the problem is, can we even get data that precise? And actually we can't, right? That's probably for sure at this stage.
All right, so let me make sure that I understand the conversation so far. So you've explained that the thing that I think we all intuitively understand is that data and any kind of data you get about the cryptocurrency space is suspect, deeply suspect. So we need to think more in terms of signals, trustable signals that we've seen probably historically that have been indicative of the truth, or maybe we have some pre-filtered selection of exchanges that we actually believe as opposed to others. The second part of that equation is having a developed relationship with prop desks or market makers and have them somehow convey to us in a way that we believe that they've seen an inventory imbalance and use that as sort of another signal to take into account. And the third thing that you've proposed is that we can begin to use those first two signals to imply that there's something that needs to be corrected, and therefore we should initiate a small and measured but regular stability fee change to see whether that has an impact on the system in a way that we expected based on our previous signals. So it looks like the peg's drifting because of exchange X 1, 2, and 3, and we trust those exchanges. Market makers and prop desks have told us that the inventory is imbalanced, and that's our second data point. And then that takes us to these meetings where we say, it's probably time for us to lower or raise the stability fee by 0.5. And then we wait to see whether a week or two, I guess, until the market has corrected itself in a way that we'd hoped and or expected. So that would be the model that we look at. Yeah,
and the critical part here, right, is that while in the last 15 minutes, this is what we could maybe try to discuss if we have time to get around to it. But while we should think about something I was mentioned last time, the range, right? Like at what point, like if we see DAI at 1.02 on GDAX, or sorry, on Coinbase Pro, right? That's a trigger, right? That's like a red flag. You got to do something, right? Like, that would be enough to trigger a 0.5% stability change potentially, right? But we, again, to go back to the TRFM thing, right? This should not be an algorithm, like, so it should not be that, if A, then B guaranteed. It should really be like, we use these sort of this alignment and this consensus we already have around what do we think, like how do we interpret these signals, and then ultimately we basically we try to basically come to a consensus on these calls, right? And the way I really imagine that, the process of coming to a consensus really is to, it really is a kind of like probably like literally every single one of you. Let me see. Okay, no, Bamsi's here. Okay, but Gonzalo. Okay. Okay. I'm not totally get off my lawn then. But like we used to have the governance meetings back in the day, right? In the first 2 years of Maker, where we were sort of running the foundation out of these meetings where we had this formal governance process and so on, right? And really the way it worked was just if no one says no, then we agree, right? So that so again, it's consensus, right? It's like not really that. It's not that people have to agree, it's just people have to not oppose. Of course, and like the reason why we moved away from that is because it's a stupid idea, right? Because anyone can come in and troll and be like, oh, fuck off, right? Let's shut down everything, right? Because I oppose anything you say. So there has to be some level of what we also in the foundation call rough consensus, right? That like it's not literally everyone has to agree, but it's just that like those who agree have to agree that they're not they have to basically agree to that they are confident that they sort of represent really a super majority, and there's absolutely no way that this proposal will not actually go through. Both because and when we think about that, right? Then we have to start thinking about the cryptoeconomics, right? So we both thinking about it in terms of literally the amount of MKR that's like represented in terms of like who believe this is the case, and also who are like similar and have MKR and believe this is the case. But actually, more importantly, it is about like it's not so much about, again, it's not about thinking who's for, right? It's about thinking who's against, and really like making sure that those who are against are really like a very small majority. Perhaps they're biased, perhaps they're like trolling, and there's not, you know, like if that is not the case, if there is a legitimate opposition, then it really should be very difficult to, you know, if there's a legitimate argument, if there's a legitimate opposition, there definitely should not be like, okay, yeah, we think it sounds legit what you're saying, but we disagree. So,
okay, let me see if I can unpack that process then. So we've talked about scientific governance, and we've talked about sort of how rough consensus is also a sort of a valid, at least pre-filtering mechanism. So, so the rough consensus would be kind of arrived at in these calls, where if there isn't some like enormously compelling or vocal objections to something, or to a proposal, then that would move on to the risk teams or somebody else would actually formulate that proposal, and then it would go into the normal governance mechanism. The thing that I'm curious about, though, is how do we maintain agility, and how much overhead does a system like this impose on the ecosystem? If we decide that, you know, there's an inventory imbalance, we need to correct that. Let's correct it by 0.5 increments over the course of X number of weeks. Does that mean that we need to return to, are we going to be sort of beholden to a weekly meeting schedule and then a week of voting? And then, so every 3 weeks we will have the ability to change it by 0.5? Like, does that sort of tie our hands a bit, or is that going to be enough in your view to sort of balance things out?
Yeah, so I have an idea for like a very strong process, but I actually don't want to talk more about that now. So rather, that's something we should discuss in writing on Reddit for the whole community, I think. Go ahead.
One thing to just throw it in there is the market signal that's sent. So, for example, when we think about the Fed and what ends up happening with different levels of rate hikes, I mean, we've seen them raise at 25 bips recently. But they've raised at much larger rates before. And so I think we want to think about not just the mechanics of the system, but the psychology of the impact that it has on market participants.
Yeah, I 100% agree with that. I mean, I think the phrase agility, when you're dealing with putting forth the equivalent of a central bank structure, the two kind of are in contrast with each other. And where you outline their liquidity issues in certain locations, how much of that can be a market solution rather than constantly beating your head against the wall trying to find and changing so frequently that it looks almost to an external perspective of almost being erratic if people aren't participating on a call where there's actually depth of discussion that goes on. So
just on that point, what you guys are saying ties back into the question that Rich asked, I think midway through the meeting, and that is, can we measure the effect of a change in the stability fee? Because that really sort of informs the whole process. The more we can increase the confidence in that, the more we can actually have a more structured view in terms of approaching the metrics that we'll identify and the actions that we need to make. Because right now, you guys have implied rather an anticipatory effect, whereby just mentioning something, you could actually have the desired effect that you want. There is a difficulty in saying, well, if we decrease the stability fee from 2.5 to 0.5, we've seen the increase in supply. How much of it is actually attributable to the fact that it was just decreased, or was it actually attributable to the amount by which it was decreased? You know, a lot of that has to be unpacked still. So we have to be careful.
Or alternatively, was it because some guy who realized he had 50,000 Ether, learned about Maker, read about it, got comfortable after 2 or 3 months, and then provided an enormous loan?
Absolutely. I mean, there's the actual structural components, which need to be unpacked as well. I mean, you're spot on. These aspects, which make up the whole data frame that we need to consider, will inform the decisions going forward. But in order to start somewhere, we need to obviously bootstrap from a reasonable place, and that reasonable place would have to talk about, well, what are the increments we want to talk about here? I don't think moving things up and down by 2% is such a good idea, just psychologically speaking. So why not, 50 basis points? The second thing is, what is the frequency of these kind of like open market meetings? Is it monthly? Should it be weekly? Or should it just be a case of we continuously provide an open dialogue on this issue and keep vigilance over the specific metrics that we want to look at? And then when we do have a point where everything seems to coalesce into a very clear sort of green light to change something, then we can take action. How that is actually structured, how that is formulated, I'm not terribly sure. I think that's going to be more organic. But in order to get to that point, I believe that we need to start somewhere very simple. And that's really where these meetings are quite essential, because it's a case of saying, we have a good construct in place. We have a good idea of what's in place. But ultimately, what we do not have is data and a diversification of opinion, because both of those two factors combined create the robustness in the system and allow it to get that momentum, to get that value that we actually require. If it's just left to the internal risk team just to come up with a function, it'll be very prescriptive, and I think it wouldn't be very maker-like, and it would be probably orthogonal to the intention anyway. So I'll leave it at that.
We keep coming back to this idea of data and where we get it and what constitutes good data. And if we wanted to measure the impact of a change, how would we do that? How do we distinguish that from randomness and so forth? So far, I think the dependent variables that we've specified for those changes are, one, some measure of the exchange rate. That sounds tractable to me in the sense of, we could go and check the various exchanges. Maybe it's not perfect, but maybe we can improve it over time and say, okay, maybe we trusted this exchange yesterday, maybe we don't today. And we can, as a community, work towards doing that if we set that as a goal and we specify what we want to get as an output from that process. Well, I guess I struggle a little bit more with the second one, which was the inventory levels and the market makers, insofar as some of that maybe on centralized exchanges wouldn't really be observable. Maybe it would make sense to discuss a little bit what we mean by that, what we want to get from that process. What do we mean by inventory levels are low? What does it mean when they're high?
And would it be in the market maker's best interest to all share that data with one another, or to share that data with us as a centralizing force, just saying, okay, we won't share this with your competitors, but if you share this with us, this actually allows us to help you all within this model and make money off of market making DAO.
Yeah, those are great points. We need to address those. I want to attack a question onto that too. Are we convinced that the data that the market makers are presenting to us are in our own best interest? Is it in their best interest to mislead us? So that's another consideration.
Yeah, so this is the most exciting part of the discussion, I think, right? And this is where I hope we would get to this earlier. But this is what we're going to talk about the entirety of the next meeting, because it's it's kind of a big deal. But so right now, a lot of DAI volume goes through these OTC disks that trade DAI with each other in like large quantities at a time, and like take them as worth $1, and then like do these big transactions with each other. And basically what happens is they're happy to do this because basically they sort of got this assumption that the foundation will make sure that it stays near $1. Maybe not the foundation. I mean, because at the foundation we have we have bilateral relationships with all the big traders, basically, right? I mean, we know them and sort of talk to them. That is kind. I mean, from that sort of level, right? They like to a large extent, right? The reason why they've gotten involved in the first place, they've got sort of interested in the first place and they're actually using it is because they believe this idea that there are some levers, some stability fees or whatever, some monetary policy that can be done, and that'll make sure that it stays stable over time, right? And that's actually what it. I mean, to the earlier point, right? It's all psychological. Like, there's actually no such thing as like, you know, like because the market or whatever, and economics and trade and so on, all of that is psychology, right? Ultimately, in that sense, like none of it is real in a way, right? It's always like humans making arbitrary decisions. So it really is about like maintaining that like idea that DAI is stable and you can count on it to be stable. And if something was going to make it unstable, it'll be the governance will change that, right? So anyway, so just to sort of pique the interest on why, like how we can actually, like my idea for how I think we can do inventory levels in a way that really makes sense, right? Is, yeah, I mean, and it's like, why does that even make sense for a market, like for market maker, for liquidity provider to provide that data, right? It doesn't make any sense for them to do that. They always want to keep that secret, except if they get something out of it, right? And that is if they actually provide really reliable, like, I mean, if you have a market maker that basically like managed to convince us of two things, right? Number one, that they always, like, they assume DAI is worth $1 and they trade it kind of like they actually trade it in a stabilizing way, right? They don't enhance its instability, rather they actually, they trust the governance. So when they see that DAI is too expensive or something, they see that as an opportunity because they trust that the governance will ensure it goes back to $1, right? And if we believe that, and then secondarily we believe that we believe that the inventory levels they're telling us about are correct, right, are true, then we really get a good, then we have a really good understanding of kind of like what is going to drive the liquidity and the stability of DAI in the market, right? Because let's say you have a market maker that like, you know, they ideally want to hold 3 million DAI, and they can hold up to 6 million DAI. And if they hit 6 million DAI, then that's too, you know, then they're too exposed to DAI, and at that point they can no longer buy DAI, right? That's gonna have, like, that means that if they're at 5 million DAI and they want to be at 3 million DAI, like that's kind of like their optimal point. That's when, I mean, and also what's happening is that apparently the stability fees are too low, right? So what's happening is over time they're accumulating more and more DAI because they're buying DAI with the assumption that the price, you know, they're assuming that the stability fee will be fixed, basically. Then yeah.
Sorry, I just wanted to add an extra one point. Yeah, a nice sort of a thought experiment. If your cost basis as a market maker or market making function shows that your inventory is, let's say, 98 cents, what are you incentivized to do? I mean, you basically you want to, you know, pull back the supply. You want to get the demand up. So your incentive there would be to contribute an increase in interest rates. If your cost basis is above $1, your incentive would be to, you know, submit an interest rate or a stability fee that is below. So you've got these inherent incentives built into where your cost basis is. The only thing that is really difficult, and this is the same problem they had with liable markets when folks were looking at the rates to clear their banking books, was that you didn't know how much weight to give to each of the contributors. Do you weight them in terms of the size of the inventory? Do you weight them in terms of the size of their banks? Or you just simply take the median of the you know, submissions and try and figure out the clearing number? To that end, you can expand from there what Rune was talking about, and add in the psychological effects, add in the anticipatory effects, adding in the actual economics that surround the broader perspective. But the cost basis gives incentive for submitting a certain type of stability fee. And then just on that basis as well, sorry, with respect to the meeting, we are at the top of the hour. So Rune, if you want to throw in your final thoughts, I think we appreciate it.
Yeah, before we jump, I just want to talk about that, like, how do we trust the market makers? How do we trust the data? And the answer is we don't trust the data, right? Just like we don't trust the exchange's data. Like even Coinbase, we can't really, like, in the end, we look at the data and but in the end we have to sort of make the final decision on whether or not we're gonna act on this, right? And in the end, it is sort of like a subjective decision in a sense, subjective is probably the bad word to use, right? But it's a human decision ultimately, because otherwise, if it's a mechanical decision, it's going to be gamed, right? But the two things we can do to kind of make us feel most secure about relying on the market maker's data, right, is we can go wide, right? So we can look at more than one, right? So we can say, look, if there's 10 market makers that are all saying the same thing, that's a lot better than just one, right? And then also we can go deep, and literally like auditing in some form, right? And again, why on earth would a market maker subject themselves to that? That would be because a market maker that's actually getting audited on this stuff is really gonna have like a massive. That would be someone who would actually be able to on their own go and be like, hey guys, we're buying and selling DAI around $1, and look, we have so much DAI now that we're gonna have to stop doing it, and that's gonna have a big impact on the peg in the market, right? Right, and if that's really, we can really feel that that's true, and we feel like that means there's gonna be an oncoming like crash in DAI potentially, right? That on its own could be a strong enough signal to result directly in a change. So that would be potentially a value, like a trade-off that's worth it for such an agent, even with the costs of, first of all, publishing data and also like being audited by some dumb decentralized community and stuff, right? But again, if there's some value to it, it could actually happen.
Okay, those are some great points, and I think that we've arrived at a point that's going to kick us off for the next meeting. So we'll focus specifically on these larger issues, but more targeted towards breadth and depth of data, who we can trust and why, and maybe some solutions around that, and see whether that leads to some next steps for us, so we can get back on the actionable plan bandwagon. So. Thank you, Rune, for your insight. That was excellent. Thank you, Steven, once again, for a great meeting. Thanks, everybody, for their great suggestions. Special shout out to Placeholder for once again summarizing what it is we're all talking about. I'll make sure that's all reflected in another Reddit post, which will go up soon after this call, after I rewatch it and take notes. And then we'll use that as a kickoff for our next meeting as well. All right, so thanks, everybody.
Thanks, everyone.
Thanks, everyone.
Thanks.
Thank you,
guys.
Thank you all.